Our latest mortgage stress data is out, so we review the results. Hi, I'm Martin North, Principal Analyst at Digital Finance Analytics. Today we discuss the latest edition of our mortgage stress research. Our analysis uses the DFA core market model, which combines information from our 52,000 household surveys, public data from the RBA, ABS and APRA, and private data from lenders and aggregators. The data is current to the end of February 2018. We analyse household cash flow based on real incomes, outgoings and mortgage repayments, rather than using an arbitrary 30% of income. Households are defined as stressed when net income, or cash flow, does not cover ongoing costs. Now, they may or may not have access to other available assets, and some have paid ahead, but households in mild stress have little leeway with their cash flows, whereas those in severe stress are unable to meet repayments from current income. In both cases, households manage this deficit by cutting back on spending, putting more on credit cards, and will seek to refinance, restructure, or even sell their home. Those in severe stress are most likely to seek hardship assistance and are often forced to sell. We also estimate the probability of default over the next 12 months by overlaying economic indicators such as employment, future wage growth, and CPI changes. Our core market model also examines the potential of portfolio risk of loss, both in basis point and value terms. In fact, we think losses are likely to be higher among more affluent households, contrary to the popular belief that affluent households are well protected. And so, to the latest results. Across Australia, more than 924,500 households are estimated now to be in mortgage stress, up by around 500 compared with last month. This equates to 29.8% of households. In addition, more than 21,000 of those are in severe stress, up 1,000 from last month. We estimate that more than 55,000 households risk 30-day default in the next 12 months, up 5,000 from last month. And we expect bank portfolio losses to be around 2.8 basis points on average, although losses in Western Australia are higher at 4.8 basis points. Some households continue to benefit from refinancing to cheaper owner-occupied loans, which gives them a little more wriggle room in terms of cash flow. The typical transaction has saved up to 45 basis points or $187 each month on a $500,000 repayment mortgage. It's enough to make a real difference. The number of households impacted by mortgage stress are economically significant, especially as household debt continues to climb to new record levels. Mortgage lending is still growing at 2 to 3 times income, and this is not sustainable, and lending growth will moderate in the months ahead. The latest household debt to income ratio now stands at a record but revised figure of 188.4. In fact, the RBA revised their debt figures down thanks to revisions in the ABS national accounts relating to how superannuation is accounted for. Previously, the debt ratio was 199.7. While the change is 6% lower, debt remains sky high. But Norway holds the record at 223%, and there they've just imposed additional mortgage lending controls. Regional analysis shows that in New South Wales, 260,830 households are in stress, up 6,000 from last month. Victoria, 249,192, down 5,000 from last month. Queensland, 165,344, up 6,000 from last month. And Western Australia, 130,000, up 5,000 from last month. The probability of default over the next 12 months rose, with around 10,400 in Western Australia, around 10,200 in Queensland, 13,900 in Victoria, and 15,000 in New South Wales. Here is the list of the top 10 postcodes across the country, sorted by counts of mortgage stress. I'll pause here so you can review them at your leisure. We expect pressure to continue to rise, and when external conditions in Australia deteriorate and all the levels of financial stress and loan defaults rise acutely, a wave of responsible lending actions seems inevitable. An early example is the finding of an important case initiated by ASIC against the ANZ. ANZ was found to have breached its responsible lending obligations when providing car loans through its former car finance business, Esanda, and was ordered to pay a civil penalty of $5 million. The legal principles established in this case are broadly relevant, as all credit assistance providers, including brokers and credit providers, are subject to responsible lending obligations. The court found that in respect of 12 car loan applications from 3 brokers, ANZ failed to take reasonable steps to verify the income of the consumers because it relied solely on consumer pay slips provided by the loan broker in circumstances where ANZ, 1, knew that pay slips were a type of document that was easily falsified, 2, received the document from a broker who sent the loan application to Esanda, 3, had reasonable to doubt the reliability of information received from that broker, and 4, income is one of the most important parts of information about the consumer's financial situation in the assessment of unsuitability, as it will govern the consumer's ability to repay the loan. And here's the important thing. While ANZ did not completely fail to take steps to verify the consumer's financial situation, it inappropriately relied entirely on payslips received from these brokers, and ANZ management did not ensure that relevant policies were complied with, and in the case of the contraventions involving one broker, no action was taken despite management personnel having become aware of the issues about that particular broker. Now, ANZ will be remediating approximately 320 car loan customers for loans taken out through these 3 broker businesses from 2013 to 2015, which are likely to have been affected by fraud. ASIC has separately taken action against the broker businesses that were involved in false submission of documents to ANZ. Now, we expect more similar stories will emerge from across the industry, and so we predict that consumer credit from car loans, loans and mortgages will all be at the heart of the next significant banking scandal or financial crisis in Australia. Standing back, risks in the system continue to rise, and while recent strengthening of lending standards will help protect new borrowers, there are many households currently holding loans which would not now be approved. And this is a significant sleeping problem, and the risks in the system are higher than many recognise. The forces which are lifting mortgage stress levels remain largely the same. In cash flow terms, we see households having to cope with rising living costs, noticeably childcare, school fees and fuel, whilst real incomes continue to fall and underemployment remains high. Households have larger mortgages thanks to the strong rise in home prices, especially in the main eastern state centres. But now prices are slipping. And while mortgage rates remain quite low for owner-occupied borrowers, those with interest-only loans or investment loans have seen significant rises. We expect some more upward pressure on real mortgage rates in the next year as international funding pressures mount, a potential for local rate rises, and margin pressure on the banks. If you found this useful, please do like the post and add a comment or question. I read them all. If you've already subscribed, thank you. I'm really grateful for your support. And if you are yet to subscribe, please do so to receive future alerts. I'm Martin North, Principal at Digital Finance Analytics. Many thanks for taking the time to watch.